they won't give you one of these tables because they don't actually want you to see how insane the numbers are. I've seen loans with $10,000 or $20,000 upfront fees. That means that you're taking out a loan for $100,000, but you're only getting $80,000. And so on day one, you have lost $20,000. And if you end up having to refinance that loan, you might lose another $20,000 again, right? But it's just it's hidden there in the text and you can't see it. You didn't start your practice to barely hang on. I'll guess you started it for freedom, impact, and profit. This is Therapy for Your Money. I'm your host, Julie Harris. I'm an accountant, author of Profit First for Therapists, and CEO of GreenOak Accounting. Over the years, my team and I have partnered with hundreds of private practice owners, whether they're just getting started, scaling into thriving groups, or even preparing to sell. We've seen it all, and we know exactly what makes a practice tick financially. On Therapy for Your Money, I'll help you build a business that truly works for you. You'll get quick, actionable tips and episodes so that you can grow a profitable practice, increase your financial confidence, and pay yourself unapologetically. Because your work is way too important for you to burn out or go broke doing it. Love the podcast? Make sure to follow and give us a 5-star review. Here is Therapy for Your Money. Hello, and welcome to a brand new season of Therapy for Your Money. I am really excited. We have lots of great topics planned for you this season. We're still laser focused on the financial side of private practice, and we're going to be diving into some adjacent topics as well. We have way more solo episodes for you this season just because there are so many things to talk about. In today's episode, if you've been thinking about taking a loan or using debt to either grow your practice or start a new practice, then this episode is for you. Because that's a question that we get all the time. Should I use debt to grow my practice? So I'm breaking down today the most common funding tools that are available to private practice owners, like a line of credit, SBA loan, credit cards, loans from friends and family. We'll talk about when to use them, how to use them, and what kind of risk you may or may not realize that you're taking on when you use debt as a way to grow your business. We will also talk about growing at the speed of cash because that's always an option that's on the table. So I would be remiss if I did not also mention that when we are talking about using debt. Okay, so here's the truth. Business debt, especially for a small business, and most private practices are small businesses, right? They're not $25 million or more in annual revenue businesses. So a small business debt almost always comes with a personal guarantee. And that is a misconception, right? That, oh, well, my business is a separate entity. It has its own EIN. So if I take out debt in the business, if I take out a business credit card, and if I end up not being able to pay it, it's not a big deal. It just will disappear. That's not true. Because when you have a personal guarantee for debt, if your business cannot pay it back, you are typically on the hook personally. Now, there are some loans where you're not on the hook up to a certain dollar amount, but typically you are personally signing your own name. And so that means all of your personal assets, your home, your vehicles, your retirement accounts, all of those are up for grabs if you are not able to pay back debt. Now, I think that's a very normal thing, right? If you're taking out debt, you're going to be responsible for it. But I just want you to be aware that it's not just this free magic money, right? So I want you to go into that debt with the same care that you would a loan that you are taking out personally. You want to make sure that you are going to be able to pay that back before you take out the loan. Okay, so whether you are using debt to expand or to start a practice, let's dive in. So there are 4 common types of loans that you might encounter in your business. The first one is a line of credit. That's typically something that you will have with your bank where you do your business banking. Because they're going to add that on to your banking products. So a line of credit is a loan that you may or may not actually use. It's there, it's available for you. And then if you need to use it, then you would move funds from your line of credit to your checking account. And then at that point, it would start accruing interest. So that's something that you often will use as more of a safety net. And I generally recommend it for most businesses. I think it's a good idea to have a line of credit. because in small business, it's really not a question of if something will go wrong, it's a question of when. So I just generally think a line of credit is good to have. It's flexible. It's typically meant for short-term needs, right? Where you have like a short-term and often really urgent need where something happens and like, oh my, I can't make payroll. I need money tomorrow, right? A line of credit is the right kind of product if you already have it in place where you can be able to access money really, really quickly. Now, if you don't have enough money for payroll, I definitely want you to be thinking about like, why do we not have enough money for payroll, right? That's a topic for a different podcast, but it is a line of credit is great for that short term, really urgent, right now need. So you're also able to use it for more long term needs as well, but you want to be really, really strategic because then you have less cash available in the line of credit for actual emergencies, right? So I kind of think of a line of credit as a little bit of an emergency fund for the business. Your interest rates are typically not going to be the best in a line of credit because it's meant to be used temporarily, right? So you're typically going to have rates that are a little bit higher than market, and that's okay. I'm still okay with a line of credit because it's going to give you a lot of flexibility. Second type of loan you might encounter is a business loan. So that is often going to be issued by a bank or some kind of lender. You might be even seeing, if you've been in business for a couple of years, like you might be getting on a regular basis emails from different lenders saying like, hey, we can give you a great rate for this much money, right? Unsolicited offers that you might see. You might also just get a regular business loan with your bank. That is an option for you as well. When you are going that route, you definitely need to know upfront how much money you're going to need to either start your practice or for your expansion, because you're going to need to show the use case, right? I need this much money for this much for equipment, right? Like, how are you going to use that money? It's really not meant to pay you. It's meant to start the business or keep growing the business. So if you are using it for an expansion, for example, you might say, well, I need this much money for first and last month, first month of rent and deposit. I need this much for leasehold. I need this much for the equipment that's going to go into the space, this much for hiring, right? That's the kind of business case that you would put together for a loan. A business loan you may be able to get fairly quickly in some cases. It really just depends on the bank and how quickly they move. In my experience, lines of credits can take anywhere from like 30 to 60 days to get. Business loan is usually about the same, depending on the bank, depending on how quickly you're getting them the information they need, right? They're going to ask for a lot of information about the business. They're going to want to see financial statements. They're going to want to see tax returns. If you are expanding and you've been in business for a while, right, they're going to want to see a lot of information to make sure that you are good for it. So in the case of these two loans, both the line of credit and the business loan, if you are just getting the business started, it is generally unlikely that you're going to be able to get these loans because your business doesn't have any history. You don't have a profit and loss and a balance sheet to show for the business, right? So those are going to be difficult to get. You might have to use a personal line of credit or a personal loan in order to get the business started. However, if you are able to get the business off the ground and making some money, right, generating some revenue, get things started for 6 to 12 months, and then you need a business loan to kind of move it along quickly, then you might be able to get a business loan. Okay, so we covered line of credit, business loan. Next, we have the SBA, which is the Small Business Administration. You can get some really favorable terms for business loans through the SBA. And so that could be a great option for kind of a long-term expansion in investment, right? Where you know it's going to take a while to pay this much money back. An SBA loan can also be good if you are buying a building, for example, for your practice, which again, you definitely should not be doing that at the beginning of your practice journey. But if at some point you are doing that, an SBA loan could be a great way to go. That is going to take a long time to fund. So I want you to be very realistic. It takes a long time, a lot of paperwork. There's a lot of red tape to get an SBA loan. It is not a quick fix. This is not money that you're going to get in 4 to 6 weeks. We're talking more like 4 to 6 months for an SBA loan to fund. Okay. So that is a much longer period. You want to give yourself plenty of time before you need that money. And then last but not least, when it comes to loan funding or using debt to fund either a new business or expansion, we have credit cards. They are convenient, they are easy to get, but they are high risk for long-term borrowing. mostly because the rates are just so high, right? These days we're seeing rates in the 20+% range for credit cards. And so that's going to be pretty expensive. There are still some 0% credit cards out there. However, you have a very specific amount of time to pay those credit cards back. And if you fail to do so, you then pay interest on the entire amount that was funded on that credit card. So you do want to be careful if you are using credit cards to fund expansion, because you've got to be able to pay that back pretty quickly. So I want you to have a plan to pay that back quickly. And here's where the catch 22 comes, right? Where if you are using debt to finance expansion, when you are expanding, I generally expect that you are going to make less profit for 6 to 12 months, 6 to 12 months after your expansion. So if you are adding a new location, my expectation is that your practice for the next 6 to 12 months will make less profit than before, right? In dollars and in percentage. And so that means that the profit that is remaining has a bigger job to do, has more work to do. It now has to also start paying down that credit card or that loan, right? In addition to paying you, adding to reserves, right? All the other things that it already does. So I want you to use debt carefully, because sometimes I see practice owners want to use debt because they don't want to reduce how much money they are taking home personally. And things are really, really tight, right? They're taking basically every dollar they can out of the practice, and they don't want that to change because their lifestyle has changed to a place where they need every dollar from the practice in order to be able to sustain their personal lifestyle. And that just tends to be a really risky place to be, because chances are your profit will go down. So just naturally, you'll have to take home a little bit less money. But then in addition to that, you have this new loan payment or credit card payment to make. And so that just tends to crunch things a lot when things are really, really tight. So I'm completely okay with you using debt to fund your expansion if you have thought it out, right? And that's the big if, the big asterisk, where if you have a plan and you know you are realistic with that plan, where you expect profit to go down, you expect to have to take home a little bit less for a while, for a few to several months, where you are realistic with how much things are going to cost, and not just thinking like, if everything goes perfectly well, this is how things will go. Because that's not typically how things work. Things do go wrong, especially when there are so many moving pieces for an expansion. Things are gonna come up, and you want to be sure that you are okay personally at home. And so I want you to use just a little bit of caution when you are putting this plan in place, and have a realistic view of how you're going to be able to um, pay the loans off. Okay. I want to come back to personal guarantees, just because most of the loans that I mentioned, right? A credit card, a business credit card will sometimes have a personal guarantee. Business loans will often have a personal guarantee. SBA sometimes, it depends. And as well, a line of credit will often have will be guaranteed towards your business assets, and sometimes your personal assets as well. So when there is a personal guarantee, that does mean that you are personally liable for the debt. Okay. If the business for some reason is not able to pay that debt, you personally are at risk. And so I think when things are going wrong, it's really easy to jump into debt and say, like, oh, let me just get this loan, which is often a more of a payday style loan for a business, and we'll just get through it on the other side. And I definitely get the desire to keep the business afloat and keep things moving along, but that is putting your entire life at risk. And I have unfortunately seen some situations, and they're really, really sad and tragic, where um a practice owner is losing their practice, where the practice just has to shut down and they have to go into bankruptcy. But in the same process, they are losing all of their personal assets as well. And that's just really, really hard to see, where they are losing their business, right? Their livelihood, and at the same time, their home, right? A lot of things they're having to sell just to make good on some of the debts. And even then, they're not paying the debts in full. They're just offering partial payments through bankruptcy to all of the debts that there were. So it's just really hard to lose all of that at once. And so I would just encourage you to use a lot of caution when you're doing that, so that you are not in that position, because it's really, really just challenging. When you are considering those what I call like payday style loans, where these are more very aggressive lenders. They're typically coming to you pretty aggressively and saying like, "Hey, we can get you this great rate." Um, those can be tempting because they usually can fund really quickly. I would want you to read the fine print, ask about personal guarantees, ask about collateral for the loans, and I want you to weigh the real life consequences. I also would love for you to ask for I want you to read every word in that loan document, even though they're usually very hard to read and complicated. Ask a lot of follow-up questions. For example, ask for an amortization table to see how much you're going to end up paying. If you have a mortgage and you log into the bank to look at your mortgage statement, you should see an amortization table that shows like, here's how much your payment is every month. Here's how much goes to principal, to interest, to escrow, right? All of those things. You can get something like that for a loan as well. And it'll show you, here are the loan payments and here's how much you're paying in interest and in principal. Because some of these more predatory loans, they won't give you one of these tables because they don't actually want you to see how insane the numbers are. I've seen loans with $10,000 or $20,000 upfront fees. That means that you're taking out a loan for $100,000, but you're only getting $80,000. And so on day one, you have lost $20,000. And if you end up having to refinance that loan, you might lose another $20,000 again, right? But it's just it's hidden there in the text and you can't see it. So I don't want you to be in that situation. And if the lender will not give you an amortization schedule, that's usually because the loan is so predatory. They don't want you to see that you're actually paying $0 in principal for like 3 years. I've seen that happen also where your loan balance is actually going up for a number of years before it starts getting paid off. And I don't want you to be in that situation because once you start, right, once you go down that road, so hard to get out of it, right? You need such a big shovel to get out of that hole. It's really, really hard to climb out. So I would never recommend that you go that route. I know it happens sometimes in a moment of panic, and there's zero judgment from me for that. But I just know how hard it is to get out of it. And so I would encourage you to just try to not get in that situation in the first place. Okay, before we go today, I do want to talk about growing at the speed of cash. It's not as exciting. It's not as fun. It is not as flashy as, taking out debt and like going big and going fast, right? But when you are growing at the speed of cash, that means that you are saving up ahead of time to fund your expansion or to fund the opening of your practice. It can really work in both ways. So you are saving either personally cash if you are opening a new practice, you're just saving up some money and saying, I'm going to need, $2,000, $5,000, $10,000 to start my practice. I'm going to wait until I have that amount of cash saved up. When it comes to expansion, the way we see that often go is there's a separate savings account off to the side where the owner is just moving extra money when they have it and saying, when I get to this dollar amount, maybe $20,000, $50,000, then I will look for a new location and I will expand to this new location because I know it's going to cost me about $50,000 when things are all said and done. And so you then get to that point, you have the cash, it's just right there sitting in a bank account, earning interest, but it's ready for you when you are ready. And then you are not taking on debt, you're not paying interest. You have a lot more flexibility, right? You may have a lot more control and peace of mind. So those are some of the pros of going that route where it's going to take a little bit longer, but you are not borrowing money. So you are not beholden to any bank or any loan. You are borrowing from the bank of you, right? You have saved up money ahead of time in your practice to be able to save that, to be able to do that expansion. That means you did not get to take that money home, right? That is a drawback. It's just sitting there waiting, but you will get to use it for an expansion. And then there is no loan payment that's going to hold you down. So some of the cons of going this way is there is going to be slower progress. And if you find a great opportunity, you may not be in a position right today to seize the day and move on that opportunity quickly, or there may be less money that you had hoped to have for an expansion. So there are some times where you might have to say, you know what, this is not it. I cannot move on this because we just don't have enough money. That is going to put us in a position of risk. And that's okay. That is okay. I saw over the last several years, a lot of business owners making risky decisions because things were going pretty well. And now that the economy is shifting a little bit where things are slowing down, things are not necessarily going as well. And so, if you're always assuming that things are going to keep increasing as far as your clinicians or clients, all that, that's not always the case. Sometimes markets slow down, and that's true for healthcare or for other markets as well. And so you want to be sure that your business can still be okay if things are not going perfectly or continuing in this trajectory forever. Because then you are going to be, you are going to be okay. So if you're thinking about taking on a loan, make sure that you have a clear ROI on how you're going to use that money. You don't want to just accidentally erode it. It's definitely not meant to be paying you. It's meant to grow the business. You want to make sure that you have a plan for stable cash flow and profitability so that you can pay down the loan, that you have a plan to pay it back. And don't just take out a loan because you got approved or you got an email. Have a real purpose for it. Takeaways for today: do not assume that your business loan shields you personally from risk. You do have some risk there. Always read your loan terms in full, as boring as it may be. Do read it, and consult with someone if you need to before you're taking out a loan. That might be your accountant, your financial advisor. Like, talk to them about the plan before going forward. If you have a business coach, right, those are great people to consult to say, like, is this making sense? And if in doubt, if you don't like high risk in your practice, just grow slower at the speed of cash, and that protects your long-term security. That's all for today. Take care. If you're looking for accounting help, head over to therapyforyourmoney.com/accounting to find information about my accounting firm and all of our specialized services just for private practice owners. If you enjoyed today's episode, we'd love for you to give us a 5-star rating on iTunes. Just head over to iTunes, click on ratings and reviews, and give us a quick shout out. We really appreciate it.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.